Welcome to my channel, and today we are talking about options basics. So what is an option, what is the strike price, and what is the expiration? Let's start with the term option. An option contract offers the buyer the opportunity to buy or sell 100 units of the underlying asset at the strike price at or before expiration, where the strike price is the price at which a buyer can buy or sell the option underlying at or before expiration. And the expiration is the date at which an option stops being traded and is converted to the underlying asset or is cash settled. Now, what does at or before expiration mean? At or before expiration refers to two styles of options. There's a European style and there's American style. In the European style of options, these can only be exercised at expiration. In the American style options, these can be exercised before the expiration date. What does converted to the underlying asset or being cash settled mean? That means usually options are converted to the underlying asset at expiration, which might be stocks or futures. So at expiration, when the option still holds some value, this contract might be converted to, for example, 100 Apple stocks if you were trading an Apple option contract. But it might also be cash settled. That means it might be converted to the value of the option in dollars, which usually happens with the SPX. The SPX is cash settled. Now, mind you that the multiplier of an option contract is 100, which means that one option contract controls 100 shares of the underlying. This means an option price of 80 cents usually means you have a contract value of $100. Similar to $80.20, the contract value is $8,200. Now, let's go over to call options. What is a call option and precisely what rights or obligations are entailed by call options? A call option gives the buyer the right to purchase 100 shares of the underlying at strike price at or before expiration. And similarly, a call option gives the seller the obligation to sell 100 shares of the underlying at the strike price at or before expiration. Now, calls usually increase in value when the stock price increases, to keep it very simple. There are other parameters that influence the price of a call, but for now, a call increases in value when the stock price, the underlying stock price increases. And the buyer profits when the call price is higher than the purchase price of the call, which makes sense. Calls decrease in value when the stock price decreases, and the seller profits when the call price is lower than the purchase price. Over to put options. A put option gives the buyer the right to sell 100 shares of the underlying at the strike price at or before expiration. A put option gives the seller the obligation to buy 100 shares of the underlying at the strike price at or before expiration. Again, in very simple terms, puts increase in value when the stock price decreases. The buyer profits when the put price is higher than the purchase price, and puts decrease in value when the stock price increases. The seller profits when the put price is lower than the purchase price. In summary, an option contract is a contract to buy or sell 100 units of the underlying asset. A strike price is the price at which a buyer can buy or sell the option underlying at or before expiration. An expiration is the date at which an option stops to be traded. Now, for calls, the buyer has the right to buy 100 shares of underlying, and the seller has the obligation to sell these 100 shares of underlying. For puts, the buyer has the right to sell 100 shares of underlying, and the seller is obliged to buy the 100 shares of underlying. Now, in the next video, we are gonna discuss in more detail what the strike price is and what the expiration is. Stay tuned and please leave a like and subscribe if you want to follow this channel.